So when I talk to people about FATCA, there are really 4 different things that FATCA does. The first one is FATCA says, foreign banks, you have to register. The U.S. wants to know about you, and the U.S. wants you to agree to comply with the rules, these new rules about what you're going to do to make sure you fully report your U.S. customers. That's number 1. It's called Foreign Financial Institution Registration. The second is account due diligence. What are the processes that you use as a bank to make sure you know who your customer is and that they're really foreign if they say so? And this has been a big one. The Big Four and a lot of tax experts have focused on this. The accounting firms and the tax experts have focused because there's a lot of changes in the rules about how you make sure you know who you're dealing with as compared to the old rules for non-resident aliens or NRAs under the existing tax withholding rules for dividends. So there's a lot of things like, what if the person has a U.S. phone number? Is there any indicia of a U.S. address? That sort of thing. There's a lot of focus on it. So there's a lot of focus on this account due diligence and making sure you don't have people that are pretending to be foreign, but they're really a doctor or a dentist that lives in Florida. Withholding.
Stevie, if
Yes.
I may, I think the key for the corporate actions folks is that in that regard, your systems need to be able to review accounts. So to the extent that you know, in the past, we were able to get documentation from a non-US resident and keep it, and with a document called WA Bend, keep it for 3 years. It's no longer the case with FATCA. So although the document itself is the same, you are now further required to keep looking for any U.S. indicia. So was there a U.S. phone number added? Was there, a location where they might have given an address, not just their residence address, that may, lead us to believe that they're, truly a U.S. resident. So you have to keep doing those checks, which means your account profile systems need to do that, and then your downstream payment corporate action systems need to read those, be capable of reading those changes.
Now, the withholding tax, that's the hammer, and that's why it's now important to understand in more detail the taxability of debt corporate actions because of FATCA. And the issue really is that even though the 30% withholding does not apply if you have an intergovernmental agreement, you might have a case where you're making payments to an entity that's not located in a country where we have an intergovernmental agreement yet. You might be a custodian in the United States making outbound payments, and 1 or 2 of the people might not be in the UK, for example. And you might find out they don't have an IGA. You, with your tax people, might be responsible for assessing whether there's withholding tax. And there is clearly withholding tax on debt that's issued on or after July 1st, 2014. And so this grandfather rule for old debt is very important, and that's what we're going to be talking about in the rest of this session. So when we talk about grandfather debt, it's debt that was issued before July 1st, 2014, and then we'll talk about, in later slides, we'll talk about provided it hasn't been materially modified. But that's why it's relevant. And finally, reporting. Dana mentioned it before, but you're going to have to report on a new Form 8966 about the income and activity in your U.S. person's accounts. So after you've identified them, the foreign bank will basically send these reports either to their local country and they'll give them to the IRS, or they'll mail them directly to the IRS.